You know how sometimes you see a problem out there, maybe pollution or, I don't know, roads that need fixing, and you think, why doesn't someone do
Oh,
something?
yeah. Happens all the time.
And well, often that someone turns out to be the government,
Okay,
right?
usually, yes.
So if you've ever been curious about the thinking behind what they do, the taxes, the spending, the rules,
Mm.
then you're kind of already thinking about public finance, SEO, as they call it.
That's a good way to put it.
We've actually pulled together some real learning materials here, some textbook stuff, even some problem sets,
Mm.
which can look a bit scary sometimes.
Ha! Yeah, they can.
But the idea is just to get a clear look at what this field, public finance, is really covering without, drowning in jargon. Think of it as getting the inside scoop on the government's economic playbook.
Exactly. We're not trying to make anyone an economist overnight. It's more about pulling out the core ideas from these materials.
Yeah.
What does public finance actually study? And fundamentally, it's really about understanding how government actions, taxing, spending, regulating, shape the economy, and maybe more importantly, why governments even get involved in the first place.
Right. Let's jump into that. Why do they get involved? Why not just let the market, handle everything? I saw the term market failure come up a lot. What's that about?
Okay, so market failure, it's basically when the free market, left completely on its own, doesn't produce the, uh, let's say, the best or most efficient outcome for society as a whole.
Like it's not working perfectly.
Exactly. It might still function, but maybe it's leading to undesirable side effects or not providing things we actually need. Public finance spends a lot of time looking at these situations where the market signals are kind of off.
Okay. And I know the materials gave some classic examples. Externalities was one. What are those exactly?
Right, externalities, they're like side effects. Economic activities, buying or selling something can affect people who aren't directly part of that transaction. Well, the classic negative one is collusion. A factory makes something, someone buys it, that's the transaction. But if the factory pollutes the air,
The neighbors suffer, even though they didn't buy the product or work at the factory.
precisely, that's a cost imposed on a third party, a negative externality. But there are positive ones too.
Yeah.
Sure. Think about someone planting a really nice garden in their front yard. It makes the whole street look better, right?
Uh-huh.
The neighbors get enjoyment, a benefit, even though they didn't pay for the flowers or the gardening work. That's a positive externality.
Got it. So costs or benefits spilling over onto others. And, thinking globally now, things like climate change, that feels like a massive negative externality.
It absolutely is. And it's a great example of how interconnected things are. It requires cooperation way beyond what, simple market fixes can usually handle. That's a huge challenge for modern public finance.
So why doesn't the market just fix these externalities itself? If there's pollution, why doesn't someone just charge the polluter?
Well, that gets down to incentives, doesn't it? With a negative externality like pollution, the factory isn't paying the full cost of its production. The pollution cost is borne by others.
So they don't really have a reason to cut back.
Not a strong financial one, no. They might produce more than is actually best for society overall. And flipping that with a positive externality, the person creating the benefit, like the gardener, doesn't capture all the value they're creating.
So maybe they don't plant as nice a garden as they would if everyone chipped in.
Exactly. They might underinvest or produce less than would be ideal. The incentives are just misaligned.
Okay, that makes sense. Skewed incentives. Now, another big area where the market apparently struggles is public goods. What defines a public good?
Right. Public goods generally have two main features. First, they're non-rivalrous in consumption.
Non-rivalrous, meaning
One person using it doesn't stop someone else from using it or reduce the amount available. Think of streetlights. Me walking under a streetlight doesn't make it dimmer for you. Or national defense is a big one.
okay, my being protected doesn't mean less protection for my neighbor.
Correct. The second feature is non-exclusive. It's difficult, or maybe impossible, to stop people from benefiting from the good, even if they don't pay for it.
Okay. Like national defense again. You can't really say, okay, you didn't pay your defense tax, so the missiles won't protect your house.
Exactly. It protects everyone within the borders. Compare that to, say, a slice of pizza. It's rivalrous if I eat it, you can't. And it's excludable, the pizza place won't give it to you if you don't pay.
Right. So if goods are non-rivalrous and non-excludable, what's the problem for the market?
Well, that leads straight to the free rider problem.
Free rider.
Sounds about right.
Yeah. If you can enjoy the benefits of something without having to pay for it, the temptation is, well, not to pay.
Uh-huh. Why chip in for the streetlight fund if it's going to be on anyway? Precisely. And if everyone or most people think like that, then who's going to pay to provide the public good in the first place? The private market might seriously underprovide it, or maybe not provide it at all. The materials mention how hard it is to get people to honestly say what a public good is worth to them.
Because they don't want to end up footing the bill.
They have an incentive to lowball it.
Okay, so the market messes up with externalities like pollution, and it struggles to provide things like defense or maybe clean air. But public finance isn't only about fixing those efficiency problems, is it? The sources mention something else.
Absolutely crucial point. It's also about fairness, equity, how resources, wealth, and well-being are distributed in society, even if a market outcome is technically efficient. Meaning, no waste society might look at the result and say, hold on, this distribution is just too unequal, it's not fair.
So the government might step in not just for efficiency's sake, but to try and make things more equitable.
Exactly. Redistributing income, providing opportunities, creating social safety nets, those often stem from equity concerns, not just fixing a market failure in the narrow sense.
Okay, so we have these reasons, market failures, fairness. What tools does the government actually use? How do they intervene?
Well, the most obvious tool, and the one mentioned heavily in the sources, is taxation.
Gotta pay for stuff somehow.
Yeah. Taxes raise the revenue needed for all that public spending roads, schools, defense, social programs, everything. And there are different kinds, like income taxes on what people earn,
Yep.
consumption taxes like sales tax or specific excise taxes on things like, say, gasoline or alcohol, and property taxes on the value of land and buildings.
And who actually ends up feeling the tax? I saw this term, tax incidence. It sounds like it's not always the person who writes the check to the government.
That's exactly right. Tax incidence is about who really bears the economic burden. It might be different from who is legally responsible for paying.
How's that work?
Think about a tax on, say, businesses. The business might try to pass that cost on. Maybe they raise prices for consumers, or maybe they lower wages for workers, or maybe the owners just make less profit.
So it depends.
It depends heavily on elasticity. Remember that from basic econ. Elasticity of supply and demand.
Vaguely.
Okay, think about demand elasticity. If demand for a product is very inelastic, meaning people will buy it almost regardless of the price, like maybe insulin for a diabetic,
Right, they need it.
then if you tax it, the seller can probably raise the price. And consumers will end up bearing most of the tax burden. They'll pay the higher price because they don't have many alternatives.
Okay.
But if demand is very elastic, lots of substitutes available, people are price sensitive, then if the seller tries to raise the price because of a tax.
People just buy something else.
Exactly. So the seller might have to just absorb most of the tax themselves, maybe in the form of lower profits, to avoid losing all their customers. So who pays really depends on how responsive buyers and sellers are to price changes.
That leads to that other concept, the inverse elasticity rule.
What's
that
that?
sounded a bit technical.
It does sound technical, but the idea is actually pretty intuitive, at least from an efficiency standpoint. It suggests that to minimize the economic distortions caused by taxes, you should tax goods with inelastic demand more heavily.
Why is that?
Because if people are going to buy roughly the same amount anyway, even with the tax, then the tax doesn't change their behavior very much. It raises revenue without significantly messing up their consumption choices. Taxing something with elastic demand, however, could cause people to drastically cut back, leading to a bigger distortion, a bigger loss of overall efficiency.
But wait, often things with inelastic demand are necessities, right? Like food or medicine.
That's the huge catch. Yes. So while the inverse elasticity rule might look efficient on paper, applying it rigidly could mean heavily taxing essential goods.
Which would hit lower-income people harder as they spend a bigger chunk of their income on necessities.
Exactly. So there's a direct conflict, often, between pure efficiency based on this rule and the goal of fairness or equity in the tax system. Policymakers have to weigh that trade-off.
Yeah, tricky. Now, income tax, specifically the materials, mention deductions and credits. Joy and Jiraiya, what's the difference there?
Good question. They both reduce your tax bill, but in different ways. An income deduction reduces your taxable income.
So the amount of income the tax rate is applied to.
Right. A tax credit, on the other hand, reduces your actual tax liability dollar for dollar or one for one.
Oh, you said what's the practical impact?
Well, the value of a deduction depends on your marginal tax rate, the rate you pay on your last dollar of income. If you're in a high tax bracket, say 40%, a $100,000 deduction saves you $40,000 in taxes.
Got it.
But if you're in a lower bracket, say 10%, that same 100,000 deduction only saves you 10,000.
So deductions are worth more to higher earners.
Generally, yes. Tax credits, however, usually provide the same amount of tax reduction regardless of your income bracket. A 10,000 tax credit cuts your tax bill by 10,000, whether you're in the 10% bracket or the 40% bracket.
Ah, okay. So credits can be seen as maybe more equitable sometimes.
They often have a more uniform impact, yes. Though deductions are often used to encourage specific behaviors, like saving for retirement, or to account for certain expenses. It also ties into the idea of tax progressivity, the overall system where higher earners pay a larger percentage of their income in taxes.
Okay, so taxation is one big tool. The flip side is government spending. What kind of spending did these sources focus on?
They covered quite a bit. Big categories like social insurance, the Korean term up came up, covering things like unemployment insurance, health insurance, workers' comp.
Right, the safety net stuff.
Exactly. Also things like subsidies for certain industries or groups, and of course, direct spending on providing public goods, infrastructure, education, defense, and so on. The idea behind social insurance fundamentally is risk pooling and mitigation, helping people weather storms like losing a job or getting sick.
And when the government spends money, it doesn't just disappear, right? There was talk of a multiplier effect.
Yes, the multiplier effect. It's the idea that an initial bit of government spending can actually lead to a larger total increase in national income.
How does that work, like ripples in a pond?
Sort of. The government spends money, say, building a bridge. That money becomes income for the construction workers and the material suppliers.
Okay.
They then take that income and spend some of it on groceries, clothes, whatever. That spending becomes income for the grocer, the shop owner.
Who then spends some of their extra income.
Exactly, and so on. Each round of spending is a bit smaller than the last because people save some income, but the initial government spending gets multiplied as it circulates through the economy. The size of the multiplier depends on how much people tend to spend out of each extra dollar of income.
Interesting. So government spending can potentially pack a bigger punch than the initial amount spent.
That's the theory, yes. The models and the source materials illustrated that.
Okay. Taxes, spending. And the third tool mentioned was regulation. How does that fit into public finance? It doesn't sound directly financial.
It's not direct taxing or spending, but regulation is a powerful way the government shapes economic activity. Think environmental rules limiting pollution, or financial regulations for banks, safety standards for products, workplace safety rules. These rules set the rules of the game for businesses and individuals.
And they have economic impacts, obviously. Costs for businesses to comply.
Definitely costs, but also potential benefits like cleaner air, safer products, or a more stable financial system. So analyzing the economic consequences of regulation is very much part of public finance.
So we've got the reasons for intervention market failures, equity, and the tools, taxes, spending, regulation. But the materials really stressed that it's often a trade-off, right? Especially between efficiency and equity.
That's probably one of the most central themes. It's rare that a government action makes things better on all fronts simultaneously. Very often there's a balancing act.
Like we saw with the inverse elasticity rule for taxes potentially efficient but maybe unfair.
Exactly. Or think about taxes in general. We need them to fund public goods, which can enhance efficiency and equity. But the taxes themselves can create inefficiencies. Economists call this the excess burden, or
Excess burden.
it's the loss of economic well-being caused by a tax, over and above the actual tax revenue collected. It happens because taxes change people's behavior. If you tax apples heavily, people might buy fewer apples and more oranges, even if they slightly prefer apples. That shift represents a loss of efficiency. Resources aren't going to their highest valued use purely because of the tax distortion.
So you lose something extra beyond just the tax money itself.
Correct. Minimizing this excess burden is a key goal in designing efficient tax systems, but again, it often bumps up against equity goals.
And how do economists measure efficiency anyway? That term Pareto efficiency came up.
Right. Pareto efficiency is a benchmark. An allocation of resources is Pareto efficient if there's no way to make one person better off without making at least one other person worse off.
So basically all the potential win-win moves have already been made.
That's a good way to think about it. If an economy is not Pareto efficient, it means there's some way to reshuffle things to help someone without hurting anyone else. There's potential for improvement. Market failures often lead to outcomes that are not Pareto efficient.
But reaching Pareto efficiency doesn't necessarily mean the outcome is fair, does it?
Absolutely not. You could have a Pareto efficient outcome where one person has everything and everyone else has nothing. You can't make the others better off without taking from the one person, so it fits the definition, but few would call it equitable.
Right.
That's where concepts like social welfare functions come in, which the sources mentioned briefly. They're theoretical tools to try and represent society's preferences about both efficiency and the distribution of well-being. How much inequality are we willing to tolerate for a bigger economic pie, essentially?
Yeah, tough questions. The materials also threw in a few other specific concepts, like the Coase Theorem. Sounded like maybe government doesn't always need to step in for externalities.
The Coase Theorem. That's an interesting idea. It suggests that if property rights are clearly defined, and if transaction costs, the costs of bargaining and making a deal, are low enough,
Big ifs.
very big ifs, then private parties might be able to negotiate an efficient solution to an externality themselves. The classic example is the polluting factory and the downstream fishery. They could, theoretically, bargain. Maybe the factory pays the fishery for the damage, or pays to install filters, or maybe the fishery pays the factory not to pollute, depending on who holds the initial right, the right to pollute versus the right to clean water.
But those ifs seem like the main problem in the real world. Bargaining isn't always cheap or easy, especially with many parties involved.
Exactly. Transaction costs are often high, property rights might be unclear, like who owns the air, and bargaining can break down.
Right.
So while it's a powerful theoretical insight, its practical application for many externalities is limited.
Okay. And then there was Lindahl Equilibrium for public goods. Is that like a practical way to fund them?
Lindahl Equilibrium is more of a theoretical ideal than a practical blueprint. It imagines a situation where everyone honestly reveals how much they value a public good, and they each pay a personalized tax price based on that value. The government then provides the amount of the public good where the sum of everyone's willingness to pay equals the cost.
Sounds efficient if it worked.
It would be, but the problem is getting people to reveal their true preferences. Remember the free rider incentive?
Right. Everyone wants to pretend they don't care that much, so they pay less.
Exactly. So while Lindahl Equilibrium gives us a theoretical target for efficiency in public goods, actually achieving it is, well, extremely difficult.
Got it. Theory versus reality. What about fiscal illusion? Casca agree. That sounds intriguing.
Fiscal illusion. It's the idea that citizens might not fully perceive the true cost of government services.
How so?
Well, government finances can be complex. The taxes you pay might feel disconnected from the specific services you receive. Costs might be hidden through indirect taxes or debt financing that pushes the burden into the future. Or the cost is spread over so many taxpayers that the individual burden seems tiny.
So people might demand more government spending because they underestimate how much it's actually costing them.
That's the concern, yes. If people have an illusion about the true price tag, they might vote for or support more spending than they would if they fully understood the tax implications.
Interesting psychological angle there. And lastly, cost-benefit analysis, which came up for evaluating projects.
Yes, cost-benefit analysis. This is a much more practical tool governments actually use or try to use. It's a systematic process for weighing the pros and cons of a public project, like building a new highway or funding a research program.
How does it work? Tallying up the good and the bad.
Essentially, yes, but trying to quantify everything in monetary terms as much as possible. You identify all the expected benefits, time saved for commuters, maybe fewer accidents, economic growth spurred, and put a dollar value on them. Then you identify all the costs, construction, maintenance, environmental damage, land acquisition, and value those too.
Then compare the totals.
Right. If the total estimated benefits outweigh the total estimated costs, the project is generally considered worthwhile from an economic efficiency perspective. Of course, putting dollar values on things like saving a life or preserving a scenic view is really challenging and controversial.
I can imagine. Okay, wow, we've covered a lot of ground there. So bringing it all together for someone just wanting to get a handle on public finance, what's the main takeaway?
I think the core idea is that public finance is fundamentally about how governments use their financial power, taxing, spending, borrowing, regulating to influence the economy. It tries to answer why they intervene, often because of market failures or fairness concerns, and how they do it and what the consequences are.
And it's really about analyzing those consequences, especially the trade-offs between making the economy run efficiently and making sure the outcomes are distributed in a way society finds acceptable or equitable.
Exactly. It provides the analytical tools to think about those trade-offs, to understand the impact of different policies, whether it's a tax change, a new spending program, or a regulation.
So it's definitely more than just balancing the government's checkbook. It's about these really fundamental choices we make as a society, about the kind of economy and society we want.
Well said.
Hopefully this deep dive gave everyone listening a clearer sense of what public finance, or CS, is all about: the key issues, the tools, the challenges.
Yeah, understanding these basic principles is, I think, pretty crucial for anyone who wants to follow economic policy debates or just understand the government's role better.
Absolutely. So maybe something to think about next time you hear about a new government policy, whether it's taxes or spending or a new rule. Now that you've got this framework in mind, which government interventions happening today seem like the most interesting puzzle? Where's that balance between efficiency and equity hardest to strike? Definitely something worth pondering.